All right, so you've made it to the third video, structuring. Now after closing, for almost all your loans, we sell the interest profit rights off to Fannie Mae and Freddie Mac. And then they repackage your loan off with a bunch of other loans and sell it to an outside investor. Now, I hope that made sense, but we can always clarify this offline. All right, now here's where closing costs are coming from. All right, we don't mean to be the bad guy and charge these to you because we want to, but Fannie Mae, Freddie Mac, the investor required these to be paid and the services performed. The first set of fees is to the title company. They charge a lien search on the property to make sure that you're going to own the house free and clear to begin with. They charge title insurance and a processing fee. Title fees are usually the most expensive. Next is government taxes. Uncle Sam always takes a piece of the pie. Third are lender fees. We set a processing and underwriting fee along with some others. The lending fees are the only fees out of all these we set ourselves. The rest are decided by third parties. Those fees that aren't charged by us are set not by us, but by those third parties directly. Now, there are different closing costs to buy versus sell. And this is important to you because if you're not going to have this house for too long, say for only a year or two, then it might not make financial sense for you to buy. When you buy, it will only cost you about 2 to 3% in standard fees, maybe even up to 4% if the home sale price is a lot lower. But not included in there is the buyer agent commission. The buyer does not typically pay this. However, this is up for negotiation now, depending on whether the seller is willing to pay for all of it now or not, case by case basis. But when you sell your house, you often pay for both agents. Expect 2.5% to 3% of the sale price to pay for each agent. And then there may be a 1% deed fee, which is a government tax. So it can cost 6 to 7% to sell. So the seller usually pays for the buyer's agent and their listing agent out of the proceeds. Message me if you have any questions on that. Escrow accounts. Escrow accounts are similar to a forced savings account for the property taxes and insurance. Instead of making a big payment to the county and the insurance provider every 6 and 12 months, you pay the monthly amount for each into an escrow account each month. When the property taxes and insurance money is then due, the lender pays that for you. All right, these are required for people that are putting down less than 20%. Now, here are the main documents needed for an approval. This is not to get your pre-qualification. Technically, I can get a little less than this, but first, you're going to have to show me your ID. Wage or salary earning employees will have to show their last 2 years of W-2s or last 4 weeks or last 30 days worth of pay stubs. Everyone will then have to show 60 days worth of bank statement histories from the accounts that they want to pull money from for closing. Self-employed earners will have to provide their last 2 years worth of tax returns, business tax returns, and sometimes a profit and loss and balance sheet. But based on your scenario, I'm going to have to ask for other documents, and it varies on a case-by-case basis. Underwriting. Now, why can underwriting feel like harassment? It can feel overly prodding, unnecessary, annoying, like it's your little sister. There's really no way around these documentation requests. All right, the 2008 housing crash mortgage mess prompted changes that made underwriting rules pretty tight. The rules that we pass on to you mostly come from Fannie Mae and Freddie Mac. The underwriters requesting them don't even necessarily agree with all of these, but they still have to enforce these. Otherwise, they would lose their licenses. Just wanted you to know that.